There has never been a time like this in history. More money has been flowing into financial markets, and yet the economies around the world have been suffering. In addition, the prospects for the following year are even worse. This is not sustainable when adding more debt on top of a weak economy is the supposed solution. This cannot end well. You came here for the truth, so let me unveil that for you. Today we're going to talk about the economic aspects and link that in with what's going on in the financial markets. It's very clear. We are watching the stock markets go higher, particularly in the United States, particularly with tech stocks. But then you look at the economies around the world and they are absolutely suffering. The question I have is, from that rubble, are we able to build back where we were before? I'm not exactly sure that people want to be back to where we were before. We want to be on a new growth trajectory. We actually want there to be a sustainable level of growth to happen. And the way that they're doing this, every single time there's a crisis, we can never get back to where we were before. Look at the interest rates as a telltale sign. They brought them back up to 2.5% in the Fed funds rate, and that was it. And they had to apologize after hitting 2.5% because apparently that was really bad. Well, this is madness that we're looking at, and I, for one, am not going to have it. We are going to get into it right away. No more ranting. Let's go. 93% of economies in recession this year, percentage of countries across the world expanding and contracting year over year. This is what we're looking at. It just shows you over the years what we've been dealing with, and it might be hard to tell, but essentially 2020 right here, it's really shocking to see how many countries around the world are dealing with the same crisis. And since 2000, we have noticed that all markets have been linked, and really since the financial crisis, even further. But now everything is so reliant on each other that there's no way to escape it. Each and every country really affects those around the world. If you have a problem that goes on in one place, I assure you it's going to affect the others. It depends how strong certain economies are. Of course, it depends on how much importing or exporting a nation is doing, but they're always dependent. Whatever resources, for instance, a country has, they want to be exporting that. They might consume it on their own, but they also want to export that. They want to produce the revenue from it, as well as importing. You want to have good relationships with other countries if you want to import that, but what happens when the supply chain breaks down? All of these things have happened at once, and that's the danger. Alignable. 48% of small businesses risk closing in Q4. I don't know if this is going to happen. It all depends on where we go into next year, but it's just interesting to see how many different surveys I can pull, how much data I can bring in, break it all down, and basically it shows the same thing, that a very large group of the small businesses stand to close. That is very bad, of course, for the economy and the jobs as a whole. This article here is talking about the restaurants, specifically New York. New York restaurants are bearing the brunt of the industry's economic crisis. Look at this. 54% of New York restaurateurs say that it is likely that they will close in the next 6 months if another federal relief package does not come through, compared to 37% nationwide. Whichever number you use, it really doesn't matter. That's a huge percentage, and that is something that's not just in the United States, but many countries around the world as well. The restaurant industry, tourism, hotels, airlines, all of these different businesses, really, they can't be sustained simply with bailouts and handouts and loans. It doesn't work long term. This is what has been happening with the governments around the world, the central banks around the world. They've decided to expand their debt. They have increased the amount of leverage they're using. This is a dangerous policy, but they're going to do it anyway. Leverage surged across all sectors in the first half of 2020, but governments suffered the largest increase, and that's the blue line as you see. Then under that is the yellow, non-financial corporates, and the orange is households. Households did not increase their debt as much as governments did, that's for sure, over this period. But as the years have gone on, there have certainly been more of this, and a lot of that is what you would call phantom, because it's not as if people have been putting more down. It is because their values in their homes, for instance, have increased at such a level that it makes them look like they have more wealth, but that is on the phantom side. It's not what they've been actually putting into their properties. Anyway, on the right hand side top, leverage increased much more in advanced economies than emerging markets, as you can see. And then there are others here at the bottom. You can look at it. It's just simply the same thing. Leverage is increasing. That's the point. And that's dangerous, of course, because of derivatives, because of debt, and because of this interlinking of the system that cannot be avoided. Worst UK contraction since 1709. UK real GDP year over year. That to me is a telltale sign that we've got a problem, not just with the UK, but it's going on everywhere. As I showed you in maybe 2 videos ago, investors have to reach for 10+ year bonds now to escape the dominance of negative yielding bonds in Euro investment grade credit. This is just giving us a breakdown. The blue areas are the negative bonds, and it's just insane to see how bad this situation has become. That's the way I look at it. If you got to get a negative yielding bond, that is not a good sign for what's been happening, because a lot of these countries are, I would say, in the high risk category, particularly as the leverage increases, and yet the amount that you're going to get in return is negative. It's just really crazy to see how this has come so far in such a short period of time. There's a lot on this chart. I still wanted to bring it to you, although I can't cover it all. It's going to bore you to death. But what we're looking at is just a breakdown of all of these different assets, whether it is S&P Tech, whether, let me bring out the highlighter here. S&P Tech is right here, and you can see the others along here, different S&P breaking down by their sectors. Then we look at this. Different bonds here in this region and different currencies here. And ultimately, as it shows us, positive areas, so the red areas equals expensive assets, and you look right here in the blue areas, which there's barely any of them at all. I don't know if you could see those blue bars. Negative equals cheap assets. And so when you look at this, it just tells me, based on so many different things, not just this one indicator or one set of charts, it is broken down in many different ways. The assets today that we are looking at are so expensive in historical terms, as well as any metric you use. They're coming up at the 98% to 100 percentile, 98 to 100th percentile of this period of time, and there's no way that we can get around that. We can't pretend that this is, well, it's kind of overvalued, but no. It is. The question is, what is actually the catalyst to turn it around? At this point, there doesn't seem like one, because the Federal Reserve has been pumping these markets like crazy. Here's a comparison with gold and QQQ, essentially tech stocks. The purple is the tech stocks, and you could see that right around that August time frame, things really changed. They were both moving upward here in 2020, and then we had a big change that occurred right around that time frame as gold started to slowly come downward. It was still up for the year, that's for sure, but just seeing how this is really separated, at least in the last 2 months or so, that has been very clear. While we have so many people that are hurting, business owners are losing everything. Other end of the spectrum, we're looking at luxury sales in some places that have been doing better than ever before. Mass market retailers aren't the only ones betting on a banner online holiday sales season. Christie's Auction House has launched its worldwide luxury week with beefed up offerings to meet this year's record demand. Weak is a loose designation this year, given that some of the sales have already started and many will last through mid-December. We noticed the same thing going on before Black Friday, actually, because all these retailers, they wanted to bring those sales and bring them into the present when it was, let's say, early November. They wanted to start these sales and say that this is Black Friday pricing. That they were hurting because they're trying to bring those sales that somebody would have bought anyway, but they wanted to make sure that they were the ones that got it. Anyway, this year we have seen a 200% increase in the number of online sales. They give you some more numbers in here and here as well, just showing you the fact that there has been, in the luxury market, many individuals who have been doing well. Maybe they bought their 7 shares of Amazon, they sell one of those shares, and now they're able to buy a new Maserati or whatever it is. So this just shows you that there has been a tale of two groups, really, when you see, or the tale of two Americas, but I don't want to say that because it applies really all around the world. Some have it, and certainly some are losing it today. This is the amount of average mortgage loan in Germany, and while they don't have as much debt as you would see in other places like the United States, this has been growing. It's been growing over the years. Look at this. From 2016 up to the present, we're watching as the prices of the homes go up, as all the other factors in their lives are becoming more expensive. Certainly, they have also to turn to debt. This is what everybody does around the world. It's the same thing going on today. IPO Frenzy. Share debuts in US are greeted by rallies not seen since the dot-com era. Looking at this, it just tells us what's been happening. This has been rising over the past few years. Certainly, we're at a 40% level at this point, but people are simply trying to get onto the next new thing. Where's the next unicorn? Where's the next kitten? This is what it's all about, and that is worrisome because if you look at them, I think the primary group of investors that are putting their money in actually don't know anything about the business, and that to me tells you something. This article here is talking about Japan and essentially what they've been doing. And I'm not going to get into the details. If you want to read the numbers specifically associated with it, they do give them all in here. But this is what I wanted to mention. How Japan nationalized its stock market. Massive government equity buying has effectively Japanified the world's third largest stock exchange. They went absolutely ballistic. And now they're the biggest single owner of stocks, the single biggest owner of stocks. And the number 2 is the pension fund. Okay. So the real investors have left. And what I worry about is that all countries are moving in this region, in this territory, and they're looking to Japan as the model of success. And ultimately what that means is that you own less, the central banks own it all. You're giving them permission to buy anything and everything, and they can decide what they want to push up or down. They decide the winners and losers. The Federal Reserve is always looking for an excuse to put more money into this system, to buy more. And so if the job situation is actually worsening, they could say, we need to continue our policies. And certainly we will see if there's any changes when the Federal Reserve has their meeting, what's going to happen. But at this point here, it's just ridiculous to suggest that they will should do any more when they've already gone so far. Just read these top 2 lines. This is shocking to me. $1.3 billion asset purchases by central banks every 60 minutes since March. To me, that is something that will go down in the books until they're doing so every 60 seconds. We'll get there. 190 central bank rate cuts in 2020. 4 rate cuts every 5 trading days. That's global central banks we're talking about. And I don't know how this ever can be turned around. That's all for this video. If you found it informative, hit that thumbs up button. When you do, you are supporting me. I want to thank you for that. If you want to learn about e-commerce, you want to know how to sell stuff online, make some money, you can do that for free at my website, theamazongps.com. If you want to know about the financial system, you want to know the ins and outs, you want to ask the right questions, definitely check out my 2 books. The link is in the description. And if you want the audiobook, you can get that at themoneygps.com. Wait a second, don't go anywhere. Have you seen this? You definitely want to check it out. Lots of info. Click on it. I'll see you there.